Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Welcome to the show, everyone. The show's called Your Money, Your Wealth. Joe Anderson here. I'm a certified financial planner. Big Al Clopine, he's a CPA. We're back again, Alan.
Another week, huh?
Back again.
Yeah, I'm pretty excited about this week because we got lots of good stuff to talk about.
We do.
Yeah.
Tons.
And you're just going to have to stay tuned to see what it is.
It's just been a whirlwind week here of just activity.
Yeah, it has.
It's just, well, I'm not sure where we should take this show.
So many directions, Joe.
So many places we could go.
I got so many things about retirement that you got to be aware of. I got some new tax planning strategies. I got some pros and cons of retiring in your 70s. And I got, I don't know.
The pros and cons of retiring in your 70s.
Yes, right.
Okay.
So
well, what's the con? You're still working in your 70s. The pro is that you have a little bit of income. And you have some.
Yeah, the pros are you get to save more money. We've talked about that,
sure.
right?
You're not spending.
You're not spending, right? So you can save up to $24,000 in your 401k or 403b, and you might have a match from your employer. And you can also put $6,500 in your IRA or Roth IRA. So you can save a lot more, and of course the corollary to that is you're not spending, so you have more years for your nest egg to grow. Working longer may be good for your health.
I would agree with that
because
it
gives
you stimulation of the mind,
some purpose and so forth. And this one, it's true. You have a shorter retirement to fund because you're going to die sooner.
Yes.
Yeah, But here's the cons. It could be bad for your health. If you have a stressful job.
Yeah, if I'm working in the coal mines.
Yeah, it could be terrible.
Right.
Plus, you got less time to enjoy your retirement while you were younger, right? And, you might pay a lot of taxes because if you're working in your 70s, you still have to take your required minimum distributions. So all of a sudden your taxable income. Not necessarily. There is a workaround on that, isn't there?
Yeah, there is.
And that is if you have a 401k with your company, and you're less than a 5% owner, you don't have to take RMDs out of that plan. And if that plan allows you to roll old 401ks or even your IRAs to that plan, you can actually avoid it.
Well, what's the average age right now, people retiring?
Well, what we've heard...
You know the stats.
Yeah, what we've heard recently is 64 for men, 62 for women. But interestingly enough, if you talk to people that are still working, when do you think you're going to retire? That keeps going up. Now it's around 66. 67.
Yeah, but then we still know that half of people are forced into early retirement.
We do. We sure do. And that's
because and then here's all these studies, I read too many of them. I'm over them. I'm over them.
You're done reading them.
Because it's like, oh, God. The baby boomers are going to have to work at least until 70. And then on the flip side of that argument is since the baby boomers are still working at age 70, there's no jobs for the younger generation because they're still working.
So they're hogging them.
They're hogging all the jobs.
Right. Yeah. So anyway.
And you know that this student loan issue that, people coming out of college, they have all these, large student loans.
Right.
It's going to make a housing crash. I read that too.
Oh, because they can't afford homes.
Oh, yeah, because they just have to pay off all the student loans.
Sure, yeah.
It's
everyone's always predicting something.
I
actually had I sat down with one of our associates at our work, and I was talking about student loan debt, and he's got about $40,000, which is probably about average. It's a lot of debt, but his brother has debt of about $180,000 because he went to private college. I don't know. How do you ever get out of that?
What's his brother doing?
Fortunately he majored in finance or business. I'm not sure what he's doing, so there is some hope, but man, that's a big hole to get out of, right? And you and I have talked about this before, and I think we both agree that part of the reason why college is so expensive is because you can borrow money, right? And so now the colleges are charging more the administrators and professors are being paid more. I hope I'm not pissing off anybody, but anyway,
I think. Well, I mean, I agree that professors should be paid.
I do
significantly.
I do too. It's a great profession.
And teachers and everything else.
Absolutely.
Yes.
But now but what we've done is we have the younger generation.
Yeah, but I don't
think
think because of all that tuition increase is going to the professors.
It's going to everything.
Right, but
yeah. You know, what's interesting is I actually know a college professor in University of Wisconsin, and he's high up in the he's like an astrophysicist, and you talk to him, you don't even understand what he just asked you. Yeah. But anyway, he was telling me when I could understand him. He was saying they actually make more money on patents than they do on tuition.
Sure, of course.
Yeah. Because if you work in the college as a professor in the college, whatever you discover is property of the college.
Got it.
Yeah. Yeah. So
astrophysicist, huh?
Yeah.
You're hanging out with the highbrow. You're highbrow, huh?
Big time, yeah.
Wow.
I remember his wife one time. I guess she was at a store shopping, and she was buying something that required assembly, and the gal goes, "Oh, don't worry about it. You don't have to be a rocket scientist to do this." And she goes, "Well, my husband is."
I mean, if they don't have a box with a picture of the end result, there's no way I could put it together.
Yeah, I agree with you.
You know?
You read these words, and you might as well be reading Spanish.
I bought an end table,
Yeah.
from like IKEA.
Yeah.
You would think, okay, here's a
how many
top.
How many choices could there be? 4 legs.
I mean, and these, the screws, they're not normal screws. There's
Yeah.
these weird. Oh yeah, whatever. That's why I get Mike Benier over.
Yeah, but
And then I bought, like, he puts together all my furniture.
Oh, he does?
Yeah, it's all cheap stuff. And without a doubt, 6 months.
It breaks.
Oh, your chair is all of a sudden, you're kind of kittywampus.
Kittywampus. That's a good word.
Yeah.
That a Minnesota word?
I guess so.
Yeah.
Oh man, Alan, I ran a little mini triathlon.
I know. Last weekend. How'd you do? Were you in the top?
Let me tell you something.
Okay.
Here, right? And I didn't really train for it because it's a mini tri, right? You do a 5,000 or 500 meter swim, something like that.
Yeah, okay.
I think it's like maybe a 12-mile bike ride and a 5K.
Okay, cool.
Right, so nothing too crazy, but it's still
doable. But that's still a good challenge.
Yeah, there's something there, right?
Yeah, right.
So get up 5 o'clock in the morning.
Yeah.
Okay, on a Sunday.
Right.
And it's like, all right, let's do this. So I have a wetsuit, but I haven't worn it in a year. Right, since the last time I did this.
I say 10 years. Okay.
And and it was, I guess, I don't know how to take care of a wetsuit because I only wear it like maybe once or twice a year.
Right.
And maybe there's some certain treatment that you have to put on it. Maybe wash it off because maybe the salt or whatever. Yeah. Anyway, so it's all crumpled up in a ball.
Okay.
I grab it out of my closet, right?
Yeah.
Grab that, put it on my arm, grab my bike, and out the door I go.
Sure.
Right? Piece of cake.
Yeah.
So we get there, and so, get my bike set up, and then I'm like, all right, well, here, suppose we got to get ready for the swim.
Yeah.
So the swim, bike, run. And so I'm like, all right, so I put my wetsuit on, and then I'm putting it on over my shoulder, and I just rip it. Just rip.
Really?
So I got this big hole, like, right in my armpit, okay? And I'm like, I don't know if I should wear this.
Yeah.
And what I'm wearing underneath is pretty embarrassing.
Is that right?
Yes, because I don't have bike shorts. Right? I don't like, where the little cushion in your butt.
Yeah, right.
But I do have, because Peer Financial Advisor sponsors this tri-team in San Diego.
Yeah.
And so they gave me as a joke this, like, leotard. Right?
So that's what you had underneath?
That's what I had underneath. Okay. And I'm like, I can't wear the leotard.
So you have to wear the ripped suit.
I got to wear the ripped wetsuit.
Yeah.
And I'm thinking, man, I don't know if I should be wearing this wet rip suit or the ripped wetsuit.
Yeah. So
I said, whatever. I don't care. I don't have any goggles, right? So you can tell how prepared I am. So I forget the goggles. So the swim, I'm going to kill the swim, right? Soon as I get in the water, boom, 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 I mean, this whole thing fills up with water.
You're sinking to the bottom.
I'm sinking.
You're trying to get out of this
thing. Oh, my
thing.
God. It's like I am like unhitch the plow.
Have to be Houdini underwater.
And I'm like, oh, my God, I don't know. Do I need a swim buddy? I might need some help. Yeah. Where's the lifeguard?
I could die.
Oh, I don't have goggles. And all of a sudden, and then it's getting in my head. And I'm like, oh, my God. I feel like I'm 400 pounds. I'm just trying to lift my arms. It's just filled with water.
Oh, boy.
Yeah, we made it through the swim.
You did,
right?
with the suit on.
Barely, yes. Yeah. And I just ripped the whole thing off like Hulk when I get out of the water. It's just, and I was thinking about taking it off while I'm swimming.
Sure. Yeah.
Yeah, right? But then I'm trying to unzip it.
Yeah.
The disaster.
Yeah.
Total disaster. So then I get on my bike. I haven't been on my bike in probably a year, right? My road bike. But I did get it tuned up. I got my, tires filled.
Yeah.
And then, so I took it for a test drive when I got my tires filled. I went up and down my driveway once, right? So that's good practice. So I'm ready to go.
Yeah.
I can't get the thing out of first gear. So it is like click, 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 click. And I'm pedaling so fast, dude. It was unbelievable. If they would have count my pedal stroke, it was I did like 400 miles.
Would have been a record.
It would have been a record. And people are looking at me. It's like click, 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 click. And I'm just like... Oh my!
They're thinking, that was the guy with the ripped wetsuit.
Yeah, and then they were like, "Oh, you can do it." I think they thought like maybe I was.
Have some
something
mental deficiencies.
Yes, maybe. Anyway, but I did. I beat Banier, so I still beat Mike.
So I take it you weren't in the top 10%.
I was not in the top 10%. No, sir. Great workout though.
Yeah.
So
imagine.
it was like I swam with,
with 400 pounds.
someone on my back.
Ride a bike in first gear.
First gears. Yeah. I did a different type of triathlon.
You sure did.
This is a financial show. Sorry about that. I just had to get that off my chest.
That's a good
So if
story.
anyone's looking at my scores, that's the reason. So you already have the excuse. All right, we got to take a break. A little beating up the clock here. When we get back, I got some questions for you. I want to talk about home equity, how you can tap into that to create some income, and a lot more. Don't go anywhere. The show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Alan Clopine. He's a CPA. Check us out on iTunes. Your Money, Your Wealth. You can subscribe to our podcast there. Your Money, Your Wealth right there on iTunes. And hey, I want to get into... I was supposed to do a webinar on Friday.
Yes.
With the co-director of the American College.
Okay.
Right? So...
this was going to be the reverse mortgage one, right?
Yeah, just kind of tapping into home equity.
Sure.
Got everything set up, ready to go.
Yeah.
A lot of great content.
Yeah.
Yeah. The technology.
Because I saw you just sitting in your office.
I was waiting.
Waiting.
Just waiting for things to happen. That's what I do all day. I just wait for things to happen. I'm a real go-getter.
Hey guys, when you're ready for the webinar, I'm here.
I'm here waiting.
Yep.
But yeah, we had some technical difficulties, so we're going to postpone that for a couple of weeks.
Bummer. Okay.
But I do have some stats here because I was prepared for this thing.
Okay, yeah, let's see what you got.
And because the bottom line is that there's a lot of times, people will think of, all right, well, I don't know. There's a psychological thing. Well, anything with money and finance, right? Is that, well, I really don't want to tap into my equity because that's almost like a last resort. Right. So there's different ways to look at this. And we're going to talk a little bit about reverse mortgages because they have changed that. There's good and bad and with any strategy. So you just have to understand kind of what you want to get into to make really good decisions.
Sure.
But there was a survey that was done, and they said 88% of the respondents had thought about where they will live in retirement. So a lot of people are thinking, okay, am I going to move? Am I going to stay in the house? Am I going to downsize? Am I going to go into a home or whatever? So a lot of people are still thinking, okay, I have this home. What do I do? Right? Do I tap into the equity? Do I not? Do I move? Do I cash out? Do I rent? 83% said they wanted to live in their current home as long as possible. And I think we see that's fairly true.
We do. In fact, I think a lot of people think they're going to downsize or move somewhere when they retire, and the stats are overwhelming that people stay in their home.
Right. So most people, right, high percentage wants to stay in the home. And then the next question is, have you ever considered how you will use your home equity in retirement? I mean, if you're going to stay in the home,
sure,
do you want to potentially tap into that? 44% said they have considered it. 56% said they had not considered their home equity.
Okay.
So, roughly 20% listed leaving the home as a legacy asset was extremely important to them. So only 20%. I thought it would be a little bit higher than that.
Sure, okay.
Because a lot of individuals that we talk to say, well, no, the home, we want to keep that and, pass that on to the kids.
You are right. That's a standard thing we hear is, what, the money that I've saved, that's going to be for our retirement, but the kids will at least get the home.
Right. And then so I think my bad as an advisor, certified financial planner doing this for almost 20 years, I just kind of assumed that that's what most people wanted because maybe I've heard that 20% of the time, right?
Yeah, right.
But then here, 50% said it wasn't important at all.
Oh, you're kidding.
Right.
Really?
So it's like, okay, well, I have this home, I have some equity.
Are those the ones with no kids, though?
Probably. Well, I don't know. It's a pretty high percentage. A pretty high percentage. So then it's like, okay, well, let's take a look at some home equity income solutions, because there's individuals that are a little bit short on savings. They might have some equity in the home here in Southern California, where we're broadcasting this right now.
Pretty common.
A lot of you have some large equity in your home. So you could sell the home and downsize, right? You could, live with family. That'd be fun.
Sure.
All right. You could do a sale or lease back.
Okay.
You could do some home sharing. How about that?
Sure.
Huh? So if you want to just age in place, this is under the category age in place.
Age in place, okay.
Yeah. So home sharing is number one
sharing.
there.
So that's what?
That's Golden Girls.
Yeah, right. Bring in roommates.
Yeah, you've seen the Golden Girls,
sure.
right?
Yeah.
So that's your favorite show, isn't it?
Yeah, every Saturday.
Blanche?
I binge watch it. 25 episodes every Saturday.
Can't get enough.
I've been through all 8 seasons 100 times.
Oh, man. You can get a traditional line of credit, or you could take a look at a reverse mortgage. So home sharing, I don't know. I don't know if that's as popular today.
Yeah, I don't think so.
I haven't really seen
I have not seen it either very much.
So home sharing is usually or mostly used by senior women. So I guess that's where the Golden Girls come from.
Got it.
Here's some pros. It's a good way to get companionship for seniors with home, and increase or decrease your, or you can decrease your expenses there because you're sharing expenses with, your friends.
Well, I mean, it does make sense, but can you imagine a bunch of old guys living together?
I don't think so.
I don't think.
Well, isn't that the Odd Couple?
Yeah,
right.
Yeah, it doesn't work.
There's no reason for a long-term care policy. You just put like 6 ordinary men in a house
dudes
together. Throw a bottle of booze in there and see who survives.
Yeah, Ralph's not doing very well. It's just, I just shut the door and gas him out.
Yeah, whatever. We'll see what happens with that. There are 4 million women over the age of 50 live in a house with at least 2 other 50-plus women.
Oh, okay.
My mother's back in town from Minnesota.
Yeah, so
I think that's what I'm
she'll
gonna
live with
do.
you for a while.
Oh, God. Well, I'm not a 50-plus-year-old woman. I have to tell her that. We're not home sharing here, Mother.
This is your home is her vacation rental.
I know. It's like, I just love your house. This thing's up for sale. I'm moving. I am definitely moving.
You're moving to a 1-bedroom condo.
Yeah.
Of course, she's still coming now.
What's that? Oh, yeah.
Yeah.
Yes, exactly. And I'll have to sleep on the couch.
On the couch, yeah.
That's what happened before when I had like a studio. I slept on the couch. She's like, I love your studio.
Yeah.
It's just so urban. It's so nice. I could just walk everywhere.
All right.
So then I moved into the suburbs. I just love your house. And like there's hills, right?
Right.
So I'm like, well, she's going to have to walk like 3 miles to get some coffee. she won't stay that long.
Tough.
It's going to be tough. No, she figures out the bus routes. She's got Uber. She's got everything.
Yeah, once you figure out Uber, you're self-sufficient.
I know. And then I put Uber on her phone. How stupid am I?
Yeah, your account, right?
Yeah, my account.
Yeah. So.
And then I was doing my family summit or my financial summit, and then it's like, all right, well here, $20,000 in Uber charges.
Why are the expenses so high this month?
Why is my Uber expense $20,000?
I don't remember having Uber in Minnesota.
Oh God, oh man. But I got to get to this reverse mortgage because there's a couple of different things that have changed. All right.
Okay. What are they?
And we don't really have a lot of time in this segment to do it, but so what's the issues with the reverse mortgage? Home equity has not always been part of the retirement income discussion, right? So people are like downside or not poo-pooing. I hate that word, but that's people are dealing with reverse mortgages.
A lot of people, they sort of take their equity as the final resort in case something goes wrong.
So let me take a break, and then when we come back, I want to dive into just a couple of different strategies that maybe some individuals might want to consider, and it's not necessarily for the last resort. Right? These you could be extremely wealthy. You could, maybe it is the last resort. But there's different things when you combine. Like Alan and I, for years, have talked on this show when it comes to tax planning with your investments, estate planning, and so on, is taking certain strategies and combining them to get the optimal result. And if you just look at one thing in a silo or in a bubble, it doesn't make a lot of sense. You're like, well, no, that doesn't make sense for me. But if you add X, Y, and Z to it, then it's like, oh, now I can see how that makes sense to my specific situation. All right, we got to take a break. We'll be back in just a second. Show's called Your Money, Your Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He is a CPA. Thanks for tuning in. Go to iTunes if you'd like to get our podcast, Your Money, Your Wealth, right there on iTunes or all the other places you can get podcasts.
You are a technical genius, are you?
Stitcher or something. I don't know, whatever.
Just get an iPad app. iPad app is what I'm trying to say.
How about if I don't have an iPad?
Or your Android. Either one.
Just go to whatever.
Or just
ask someone.
Just ask someone else that knows how to find it.
We're talking some home equity, using your home equity to create some income, to help supplement some income.
Yeah, and Joe, I think that's an important topic because a lot of people in Southern California, they find it challenging to save for retirement because cost of living is high, but yet they got a home. They got a lot of equity, and so how do you take advantage of it?
Well, let's first talk about the reverse mortgage, or HECM, home equity conversion mortgage. It's a non-recourse loan, all right, first of all. You pay for insurance from FHA or HUD, multiple distribution options that you can have, which I think a lot of times people don't understand.
Right.
You can get a 10-year lump sum. You can get a line of credit. The line of credit is seen as most favorable from financial planners. All homeowners homeowners must be age 62, can have non-borrowing spouse under age 62. Mortgage does not need to be entirely paid off. All
right. Yeah, because you can use a lump sum to pay it off.
Right. So let's say if I have a mortgage, I can do a reverse mortgage and not have my mortgage payment anymore.
Right.
Right. And so then that could free up whatever that mortgage payment was, $1,200 a month or something like that. Let's see, the loan is due when you stop using the home. So if you sell the home, or when you pass away, move out, die, go to a nursing home, sell the home, or whatever.
Right.
Okay. So those are just a couple of different tidbits there. But the loan is still there, though, right? It's just your equity then is reduced.
Yeah, so what happens, Joe, is of course either you borrow a lump sum or a payment stream or just a line of credit that you can draw as you need it. And so then what happens is you don't actually make payments. The interest that you would have normally paid just keeps accruing and adding to your loan. And so then when the house is sold, let's say when you pass away, then whatever the loan is, it gets paid off by the equity. And interestingly enough, Joe, if let's just say the loan is higher than the equity, the lender cannot go after the kids. It's non-recourse, as you said, which means that the loan is only satisfied by the house itself. Now, that probably doesn't happen in a lot of cases, and the reason is because they'll generally only loan you about 50% loan to value.
And the maximum value of the home is
$625, which is the maximum FHA rate. So let's just call it $600. Easy.
And there's probably jumbo loans. In full disclosure here, I know there's probably some mortgage brokers listening and saying these idiots don't know what the hell they're talking about.
Well, and
we're not mortgage brokers. We're just giving you some ideas to think about, because there's products out there now that have enhanced.
Right.
And you might want to encompass some of this into your overall financial plan.
Yeah, I think so too. But I will say there's different areas, different counties have different maximum rates. But I think the highest one is $625.
I think it's based on the growth, right? So I mean, if you take a look at La Jolla versus Minneapolis.
Yeah, but it's based upon counties, I think. But anyway, just to give you a quick example, let's say the maximum rate were $600,000, just to do an easy example. Even though your home is worth $1 million or $2 million, they'll count the maximum FHA rate, and then they may only loan you half of that. Let's say $300,000. So that's, if you're trying to get a lump sum, that would be approximately the amount. Now, the older you are, the more that they will give you, because then actuarially you've got less time to live. And the younger you are, let's say if you and your spouse are 62, it might be even less than that. But that's, that gives you an idea of the numbers here.
So there's the bad news, right, when it comes to reverse mortgages, is that you got a couple of idiots like us talking about it that we don't really sell and understand the product on to its full degree.
We try our best, though.
Let's see. Historically, a lot of people use them poorly. There's a ton of misunderstanding, compliance issues. There's, when you look at compounding interest rates are not ideal because those compounded interest rates are compounding in your equity.
Yeah,
right?
and they're higher interest rates than you would normally get with a mortgage loan.
And then there was a lack of research on using the reverse mortgage and what was like the ideal or the best strategies to take a look at. There's negative perception on it, overly aggressive marketing by mortgage companies and so on. And the product and regulations, they keep changing. So how do you use a reverse mortgage properly? This is by Dr. Fowl. All right.
Okay.
So a few different things here is that, well, let's see. There's a strategy to defer your Social Security.
Yeah.
So let's say I want to defer my Social Security to age 70, but I need some cash flow because that deferment of Social Security is going to increase that Social Security benefit by 8% once I reach my full retirement age. It's called a delayed retirement credit. Well, hey, and that's guaranteed by the federal government. That's a pretty good deal, but I would love to delay to age 70, but I need cash flow.
Yeah, so here's a way to get cash flow. If you don't have any other savings, you get this home equity line on this reverse mortgage and pay for your bills that way. That's a great strategy, Joe. And then plus Social Security, worst case, only 85% of it's taxable. So 15% is tax-free federal. And by the way, it's all tax-free to the state of California. So if you can get those amounts up and higher, you've got a tax-efficient income stream for the rest of your life.
So you're taking a loan, let's say at 4%, that you don't necessarily have to pay back if you didn't want to utilize the equity in your house anyway.
Right.
Right. So the loan is at 4%, and you're getting an 8% credit on the compounding of, and then plus whatever the COLA is on your Social Security.
Yeah. So it's worth a look. Yeah.
Cash flow management, and so that kind of goes hand in hand. Is that all right? Well, maybe you flip your traditional, which we talked about. You flip your traditional mortgage into a reverse mortgage. That would free up some cash flow, so you don't have that monthly mortgage payment anymore.
Yeah, like maybe your mortgage is $300,000, and you just pay it off with a reverse mortgage, and you don't have any payments anymore.
Tax efficiency is one. So Roth conversions and tax efficient withdrawals. So if you're moving up your taxable income to certain levels, could it be better to withdraw from your home? And because the loan that you receive from your home is, guess what, tax-free.
Right, because it's borrowing.
It's a loan. So the IRS doesn't classify a loan as a taxable event. So that income, quote unquote, is tax-free. Your loan that you're taking from your equity from the house is tax-free to you. So then, now I have cash flow that I can live off of, and then I'm utilizing other strategies, right? I might take some of my retirement accounts and convert those into Roth IRAs because my taxable income is fairly low.
Yeah, so let's see. So you're in a low bracket because you're living off your home equity loan. So therefore, you can do a Roth conversion, taking money out of your 401k IRA, converting it to a Roth, which is counted as income. You pay tax on it, but maybe you do enough of a Roth conversion to fill up the 10 and 15% bracket, maybe some of you the 25% bracket. So you're paying taxes on it, but at lower rates. And then later on, when you withdraw money out of the Roth, it's all tax-free.
Right, and so you look at this, and you have to run the numbers here. This is where it gets a little bit more complex, is that, hey, maybe I take out that reverse mortgage, right? So I'm living off of those dollars. I'm letting my investment assets continue to grow. I'm taking the tax-deferred assets that I have in my retirement account. I'm going to strategically convert those into Roth IRAs, so all of those assets will continue to grow for me tax-free, right? And so it's running these numbers, but yeah, your equity is going to get chewed up here in the meantime, but your other assets are continuing to grow. Right, so then you have a larger nest egg. If you want to then give more to the kids while you're living versus saying, hey, you get the house. If you want to give more to, so there's different ways to look at this. It's utilizing your entire net worth for your overall strategy. And then once you put tax into the equation now, I think that's where people will get surprised of actually how cool some of this stuff could actually work out for them, no matter what their net worth is.
I think you're right, Joe, because when you think about this, when you're pulling money out of this home equity loan or this home equity loan line of credit, it's not taxable, so you can stay out of higher brackets. And now it's all about getting control over your taxes. Because if you think about it, if all your money is sitting in traditional retirement accounts, it's all 100% taxable. And for a lot of you, that's where the majority of your savings is. If there are a way to get control over your taxes, and the home equity loan can be a tool, if you utilize that with other strategies so that you can pay less taxes for the rest of your life. And it's amazing to me, Joe, that not a lot of people are getting this information. There's a lot of ways to reduce taxes in retirement, but so many people focus on just your investments, which of course are important, but taxes are equally important.
All right, we got to take a break. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back. Welcome back to the program. Show's called Your Money or Wealth. Joe Anderson here, certified financial planner with Alan Clopine. He's a CPA. Thanks for joining us. Thanks for being part of the show.
Yes, we appreciate your listenership each and every week.
Yes, sir. We're going to get to some email questions here in a bit, but you got some hodgepodge potpourri versus.
I do. Actually, we got
great articles that we go through with our crack research team.
Yeah, I actually got a good article this time, Joe. This is a fairly big news for those that work and live in California. So Jerry Brown this last week just signed into legislation a new bill that will. It's called the State's Secure Choice Plan. And what that does is that will allow those that are working for companies that don't currently have retirement plans to actually get on a state retirement plan. This it's expected to cover about 1.6 million workers in the first year alone. And ultimately, about 6.8 million workers in California will be eligible. And what it is, by the way, is
they're already eligible for a retirement account.
Yeah, but you know why this is significant? Is yes, they are, but no one does it because of the whole concept of you get your paycheck and then you spend it and you're going to save the difference and you never have anything to save.
So this is coming directly from the paycheck.
It is. So it's coordinated with the employer. That's what's going to make this different. Now it is using the MyRA, which
Hoorah?
it's the MyRA, MyRA, which was introduced by President Obama a few years ago. And interestingly enough, remember in one of his State of the Union speeches, it was going to be the greatest thing to save retirement plans. I'm going to guess this was like 4 years ago. Anyway, I got the stats. There's 15,000 accounts so far.
15,000? That's it?
That's it.
Oh, my God.
So it didn't catch on. But State of California is going to start with the MyRA because it's there and available. And
all right, so let's kind of take a step back here. Is that you work for an employer, you want to save for retirement, they don't have a retirement account.
Yes.
However, you do have an account available. You can open up a Roth IRA
You
or a
can.
traditional IRA,
You
$5,500. But then you would have to go
You'd have to
and
do it
open that
yourself.
yourself. You
Right.
would have to, oh my gosh, get online.
Yeah. So yeah.
It could push
and
a
actually put money in it,
Yes.
right? So here's how this would work, and it would start the first year with employers with 100 employees or more that don't currently have a retirement plan, and this is an opt-out plan, so you have to do it unless you say, you know what, I don't want to do it. So a lot of people won't know the difference, so it'll just start happening. And some people think this will start at about 3% of your pay. Other people think it'll start maybe at 5%. We'll have to see. It's still being determined. But at any rate, it's a way for those that work for an employer that don't have a retirement plan have a nice, easy, simple way to get money into a MyRA, which, by the way, has the same rules as a Roth IRA in terms of you can put in $5,500 per year, and if you're over 50, you can do $6,500.
The difference is the investment, right? With an IRA or individual retirement account, you can buy stocks, bonds, mutual funds, ETFs, whatever.
Right.
With the MyRA, you're buying treasuries.
You're buying U.S. treasuries, so they don't really make very much money. They're secure investments. Now, when the account gets up to $15,000, you're required to roll it out to a Roth, and of course, then you can pick any investments you want.
So, is that still going to be the case with these employer plans?
Well, that's a good question. This article didn't talk about it. But
right. So let's say, I'm going to work for this company for the next 15 years.
Yeah.
And I want to max it out, $5,500.
So 3 years.
3 years, I'm done.
Yeah. Well, what they're saying is that within 3 years, they're going to have their own plan. So they're just going to roll it into that. In other words, the state of California, is going to have a plan.
So we're just piggybacking on the federal MyRA plan at this point
temporarily.
Until we come up with another retirement account because there's not enough.
That's right.
There's a Keogh plan, there's a SEP, there's a Simple, there's an IRA, there's a 401k, there's a 403b, TSP, 457.
Yes. Right.
Like, you want me to go? Ridiculous.
Let's get another one.
let's throw another one in there. Do
But,
I have the MyRA or do I have the Kyra?
But why this is significant, Joe, is that it's a kind of a forced savings right out of your pay. Out of sight, out of mind. We talk about that pay yourself first. It's very hard to do when you just try to save money after you wait till month end and see what's left over, because you'll find ways to spend what's in your checking account. But if it comes out of your paycheck before you even see it, out of sight, out of mind, you don't miss it. And that's why this is, I think, a good thing.
Yeah, no, I agree.
And then within probably, it says about 4 to 5 years or so, 4 or 5 years, then they're going to get it down to employers that have 5 or more employees. So this will cover a lot of companies.
Well, I hope what happens here is that the federal government or the states will say, instead of the 5,500 rule, let's get it to the 18,000
That
rule.
would be fair,
and
wouldn't
then
it?
the catch up to get it to 24,000. Because in my opinion, I think more and more of these small businesses are not going to, they don't want to hassle with the 401k plans at all. They don't want to deal with it. And then most of these, smaller employers went to these brokers to set up their plans.
Right.
Right. And how the broker gets compensated is, through the fees and commissions of these plans. And so the brokers are not going to go in there because they're not going to be compensated to set up the plans, because the fiduciary rule, which I am a full believer in. Sure. But I think there's a double side to that, is that, all right, well, here, I don't want to set this plan up because I'm not going to get paid on it. And then the employer has to do all this due diligence. And, look at all these employers, these big employers now that are getting sued, by the employees. Sure. I mean, brokerage firms are suing.
Right.
Like Morgan Stanley. They're suing Morgan Stanley. Morgan Stanley brokers are suing Morgan Stanley because the 401k sucks.
Exactly. Yeah, and so another benefit, I guess, if you're an employer, is there's no match, no required match. So this won't cost the employers anything other than a little bit more administration, because they got to run this through their payroll.
Right. And so if they can get it up to a reasonable amount where you can defer, I think then that's a step. I guess we're moving in the step.
Yeah, we're moving in the right direction. Interestingly enough, Joe, California was the first state to investigate this concept, but others have already enacted this: Illinois, Maryland, Connecticut, and Oregon, to name a few. And hopefully other states will get on board, and hopefully we'll have a federal program that's just consistent. And I agree with you, because if a 401k is $18,000, and if you don't work for a company that has a 401k, why can't you put in $18,000?
Exactly. And I don't want the federal government in there too, because it's only going to treasuries that you can invest in.
Well,
so let's say
it needs to be something different than that.
You got to have choice. You got to have. Hey, maybe I want to go 100% take out market risk.
Yeah, and if you're in your 20s, do you really want to be invested in
T-bills?
No,
of course not.
Yeah, I mean, it's you want to invest in something that has a higher expected rate of return. More volatile, yes, but higher expected rate of return. You're not going to touch it for 40 years.
I mean, unless you blow yourself up by pulling it out early and paying penalties and everything else.
Sure.
So the government has already done enough of, I guess, guarding us against our money.
Right.
And saying, hey, against our 401k monies, by saying, hey, if you do take it is your money. If you take it out, that's fine, but we're going to heavily tax you and penalize you.
Right.
So sure, if you want to take that $50,000 out to do whatever you want, you're going to pay $25,000 in tax. Roughly.
Yes, that's right.
Got to take a break. She'll cut your money or wealth.